According to our latest data, the Turkish lira-based deposit share increased to 45% from its low of 31% in August of last year. Moreover, despite the high inflation environment, the banking sector maintains strong profitability, which supports banks' core capital. Although profitability has somewhat declined during the hiking cycle, the sector continues to be profitable in terms of return on equity and return on assets. The sector never had significant issues accessing global financial markets. The resilience has in part been the result of diversification in lenders, debt instruments, and maturity structure. The share of external funding in total liabilities stands at close to 15% as of March 2024. More recently, the hiking cycle and improving global confidence in our disinflation path has also improved the outlook in external financing. We are also observing an increase in foreign investors' appetite for Turkish banking sector's debt instruments on the back of policy normalization and declining trend in Turkey's risk premium. Public and private banks have issued a large number of long-term Eurobonds in 2023 and this year. Eurobond issuances have reached approximately $13.8 billion since September of last year. Since the beginning of this year, the total Eurobond issuances amount to $7.8 billion, and total subordinated debt issuances amount to $4.1 billion. In addition, banks are rolling over their syndicated loans at favorable conditions. The rollover rates in the syndicated loan market has been around 130%, with a 175 basis point decline in risk premium compared to last year. Our monetary policy will continue to support the growth of the banking sector. We have thus far realigned macroprudential regulations to complement monetary tightening. These regulations serve to sterilize excess Turkish lira liquidity, support the transition to Turkish lira deposits, and safeguard against excessive credit growth. However, we are in a transition phase, and we realize the costs imposed on banks due to the distortionary nature of macroprudential regulations. That is why, along with the hikes in policy rates, we have explicitly stated that the simplification in the macroprudential policy framework will be a policy objective going forward. To that end, we have recently abolished all of the remaining security maintenance requirements, which were impeding the healthy price formation and market functioning in the Turkish lira bond market. Distinguished guests, before I end my talk, I'd like to share a few thoughts on Islamic finance and recent developments in financial technologies. Let me first start with a clarification. We call Islamic finance participation finance in Turkey, and banks that are governed accordingly are called participation finance institutions. The market share of participation finance has been rising in Turkey and is at 8.7% as of March. However, there's still much room to grow. Indeed, the recent IFSP data reveals that Turkey has just 2.8% share in global Islamic banking assets. The asset size of the market globally is expected to reach $3.7 trillion by the end of 2024, according to a recent report by the Islamic Financial Services Board. We see significant potential contributions from the growth of participation finance for the Turkish economy. First is its obvious role in raising financial participation, diversifying Turkish lira financial assets, and deepening capital markets is a key objective to support financial stability going forward. Second, instruments in Islamic finance tend to be easier in terms of risk management, which again is a plus for financial stability. Finally, Islamic finance is growing globally at a steady pace, and we would like to make sure that this is a market that Turkish banks and corporates can access. We therefore remain committed to support the establishment of the necessary financial and regulatory infrastructure that will allow participation banks to grow further. For example, we have been trying to level the playing field across participation and conventional banks by specifically tailoring our regulations for participation finance institutions. We further provide technical assistance and support to other regulatory bodies in fine-tuning the financial architecture to better accommodate participation banks. As you may be aware, we as the CBRT are also responsible for the safe functioning of the payment systems in Turkey. Our instant payment system, FAST, and its security overlays continue to be improved in-house, while work on the digital Turkish lira continues. New challenges and opportunities continue to emerge in this field as financial innovation is now receiving a further impulse from the emergence of AI applications. As a CBRT, we are now adopting AI in ensuring the security of our payment systems through the Instant Payment Systems Overlay called CPER. AI's advantages in rapidly processing large data and detecting anomalies presents an important opportunity in detecting suspicious transfers. We are also aware of the risks that financial technologies pose to payment systems and even to financial stability at large. Going forward, we will need to continue to keep up with financial technologies as a regulator. The financial sector is innovative and quick to adapt to any new innovation, meaning that the regulators have to adopt a similar approach in building safeguards. Let me conclude by thanking you all for coming to Istanbul and attending. Looking at the agenda, I'm sure that this event will prove useful for all attendees and hope that we see you in Istanbul more frequently.